thanks for joining Jeff and I today. What is going on in your background? Where are you today, Jeff?
Well, it's a theme, Sonny. It's an industrial center.
Yeah, okay. And
It
I look like
matches.
I'm in a warehouse?
Yep, that's it. That's the point. I get
Yeah,
AI to generate these photos based on the topic we're doing, and it's
yeah,
doing a good job.
it is. So that leads us to our topic today, which is Dream Industrial REITs. And Dream Industrial REITs has several hundred properties totaling over 75 million square feet across urban markets in Canada, which is approximately 62%. Europe is approximately 25, and US is about 13%. The REIT just raised, I guess, a monthly distribution of uh, the first time in 13 years with an annual yield of about 5%.
Yeah.
Do we think going forward this REIT will produce more increases in the dividend yield?
Well, that's what we wanted to write about. I was surprised when the earnings came out a few weeks ago to see they increased the dividend. And as you say, yeah, it hasn't happened in 13 years. So they were asked on the call if they'll make this a regular, recurring uh, thing we can expect at once a year. And management didn't say yes, but they didn't say no. And so we wanted to write this blog to say that we can think of three reasons why the company can continue with annual distribution increases. And if they are successful in doing that, it will lead to a higher valuation on the stock and more income. So, why don't we go through our three reasons as to why we think a regular distribution increase is something investors can expect?
Okay. So the first one's closing the 26% rent gap.
Yeah. Okay, I'll take this one. So right now, with the properties that they own and lease out to tenants, the in-place rent is about 26% below what the market value of that rent is if it were to be leased to a fresh new tenant today. And so that's obviously because when they rent out their locations, the tenant will take a long life on the contract. And so as those leases mature, the rent will roll over into market value. So of the three catalysts, this one's my favorite because they don't really have to do anything. They just wait for the leases to roll off and they'll be re-signing new leases for much higher levels. So that's reason number one as to why we think that the company can increase their distribution in the future. Number two,
Okay.
why don't you take the data centers?
Okay, so the data centers. Currently, the Dream REIT, Industrial REIT, has about approximately 13 properties in Canada that support the data centers, meaning that they are committed to, I guess, electrical companies in the Greater Toronto area.
Yeah, and uh, I mean this company is mostly urban, so a lot of their locations are close to places like Toronto. They're seeing good growth in Calgary too. They singled out that city. So I think with artificial intelligence and its growth, you need the data centers to support it, and so this will lead to more cash flow for the company if they build it out. Okay, and then the last and final reason is the high and predictable occupancy. So this company went public in 2012, and since then, their committed uh, occupancy has been always in the mid to high 90s, and it doesn't fluctuate very much. It's been about between 95 and 99.1% from 2012 to today. It's sitting
Mhm.
at around 95%. But when companies are planning for a dividend increase, they always consider how stable and predictable their cash flow is because it's humiliating to have to ever cut your dividend. And so, because this is such a stable company and has predictable cash flow. We think that the high occupancy is a reason that its board can use to justify a higher distribution going forward. I keep using the
Yeah.
words dividend and distribution interchangeably. They essentially mean the same thing. It's money going to the shareholder. They're just taxed differently. But we won't get into that. You can just think
Yeah.
of it as a payment to you in exchange for owning the stock, or in this case, the units. REITs are a little more complicated, but it's just a tax thing. So
Yeah.
those are the reasons we think that future dividend hikes or distribution hikes could be in the cards. It's the gap between in-place rent and market rent, the build out of data centers on some of their locations, and the high predictable occupancy rate.
Yeah.
So I think we can
Income stream.
hopefully expect more of these hikes to come in future years.
Yeah. Okay.
Oh, and I don't recall if we mentioned it or not. Do you want to just give the disclaimer?
Uh, I can read it out loud.
Well, you don't have to read it, just that we own the stock, and I think you had did you have the cost information at hand of what
We purchased it back in April 2024 at $12.73. So it's about a 23% growth.
there you go. Okay. And we keep adding
Yeah.
it for new clients too. And even when we're rebalancing existing portfolios, we've been buying it here as well. So still has a good upside in my view.
Yeah.
All
Okay.
right. Okay.
Thanks,
Thanks,
Jeff.
honey.